This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 444 was produced on September 5th, 2024. I'm Eric Townsend. Sachem Cove Capital CIO and fund manager Mike Alkin returns as this week's feature interview guest for a deep dive on uranium markets and why they've been so slow to respond to rapidly improving bullish fundamentals. We'll discuss everything from market structure to why there's no liquid futures contract to how the utility buyers are compensated and why they're so complacent with respect to the numerous growing threats to global uranium supply. I'll be in London at the World Nuclear Association conference when this episode airs, so I'm going to leave the Postgame segment in Patrick and Nick's able hands. We'll be back to our regular show format next week when I'll also have a report on what I learned at the WNA conference that I'm attending as this episode hits the podcast feeds.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, September 4th, 2024. The September S&P 500 futures down 143 basis points to 55.30. The bull advance stalled on a weak ISM number. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The US dollar index up 24 basis points, trading at 101.27. The October WTI crude oil contract down 714 basis points, trading at 69.20. Another leg of selling, bringing it down towards its multi-year lows. The October RBOB gasoline following oil lower, down 485 basis points to 196. The December gold contract down 43 basis points to 25.26, consolidating from its highs, but no deep pullbacks yet. Copper down 169 basis points, trading at 408. Uranium up 19 basis points, trading at 79.35. And the U.S. 10-year Treasury yield down 7 basis points, trading at 376. It's trading right at the year lows going into the much anticipated jobs numbers. The key news to watch this week is that Friday's jobs number, and next week we have the CPI and PPI inflation numbers and the ECB monetary policy statement. This week's feature interview guest is Sachem Cove CIO Mike Alkin. Eric and Mike discuss the structure of the uranium markets and the coming challenges the industry faces. Eric's interview with Mike Alkin is coming up as MacroVoices continues right here at MacroVoices.com.
And now with this week's special guest, here's your host, Eric Townsend.
Joining me now is Mike Alkin, CIO and fund manager for Sachem Cove Partners. Mike has prepared a slide deck to accompany today's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com. Look for the red button above Mike's picture that says looking for the downloads. Mike, I can't believe it's 4 years since I've talked to you. I want to just let our listeners know that because of my travel plans to the World Nuclear Association conference in London, we recorded this interview fully 8 days before you'll hear it, way back on August 28th. So please excuse us if we don't have the latest market news. Mike, I want to start with the structure of this market because I think, frankly, a lot of people, other than yourself and a couple of other real pros, don't really understand it. So let's start with the simplest question. You know, if I'm running a trucking company, I don't have to buy crude oil and hire some, contract with a refiner to refine it for me. I just buy diesel fuel if that's what I need to run my trucks. Why do utilities have to buy unrefined U3O8 yellowcake uranium and then contract for the conversion and enrichment? Why don't they just sell nuclear reactor fuel in a finished product market?
It's a great question. Well, first, thanks for having me again. It's a pleasure to catch up again. So, historically, the fuel buyer, and let's understand what a fuel buyer is, right? Most fuel buyers are nuclear engineers. And if you think about this, the market is defined by one where about 85% of the pounds that are purchased in a year go through a long-term contract market. From 3 years forward from the date signed, and it could last 5 years, 7 years, 10 years. That's what a term market is. That's the vast majority of the pounds sold. And on occasion, the spot market comes into play, which is 15, 20% of the pounds, depending on the year, sometimes a little bit more. Post-Fukushima, there happened to be some pounds backed up that wound their way into the spot market. But if you're running a nuclear reactor, you can't switch to natural gas or coal. It is what it is. So security of supply is paramount. So the folks running these, very smart people, but they're infrequently discovering price. They're not in there. They're not coal traders or natural gas traders or oil traders. They're in there very infrequently. And what they do is they want to control the process, right? If you think about the nuclear fuel cycle, if you're buying coal or gas, you're not talking about the coal cycle, the gas cycle. You buy it and pretty soon it's at your plant gate. Here, you're talking, it could be upwards of 2 years, right? U3O8 is mined. It gets converted to UF6. UF6 then goes to the enrichment plant that gets enriched. Then it goes off to fabrication. And you're saying, like, why don't they just buy EUP? Sometimes they do just buy EUP. They can go into the market and buy enriched uranium product, but most of the time they want to control the process. They want to be in charge of what shows up and where, and they want to know they have that capacity. So they contract at each step along the way. And to know the fuel cycle, there's a product in the fuel cycle. That's U3O8. That's the uranium that comes out of the ground. And then from that point forward, there's services. So conversion is a service, converting U3O8 to ultimately U3O8 becomes UF6, and then UF6 becomes enriched, and then it goes to fabrication. Those are services that take the natural uranium and convert it in. And so the utilities want to control each step of that plan. Now, sometimes they'll do a little horse trading. They might take in some enriched uranium product. Some EUP, and in that, there might be some conversion, there may be some enrichment, there's other things that they could strip out and they could sell to others. And, that's getting deeper into I don't want to go down a rabbit hole, but they want to control all portions of that. And so, because it's that, like I said, their number one job is security of supply, because there is no substitute for what they do. So they want to carry it. And prices of these will move at different times, because at each stage of the fuel cycle, Eric, there are different market shares and there are different players. For instance, in enrichment portion of the fuel cycle, which is where, uranium U3O8 by itself is nothing. UF6 needs to be enriched up to 3 to 5% levels to be able to be fissionable and create a reaction. When you're looking about those, enrichment is controlled up in 40% of the market is Russia. Then you have the West has Urenco and Orano, and so you can get some. You'll have market share there. China has some enrichment capabilities, and so it's very controlled by state-owned players in enrichment. So their capacity is tighter, and now. After Fukushima, it was looser, but in a market where prices are rising and capacity is tightening, they tend to flock to it. And to put some context around that, about 5 or 6 years ago, the price of enrichment, which is priced in a unit of work called a separative work unit, was about $35 per SWU, would be the acronym. Today, a unit of SWU is $176, right? So it's gone up multiples. If you look at conversion, the act of converting U3O8 into UF6, that was back in 2016, 17, $4. Today in the spot market, it's $68. Why? Because a lot of capacity had to be taken out of the market during the downturn. And the commitments haven't come back in full swing for the converters to not only just bring back the capacity, but add new capacity that is needed. And so if you're a fuel buyer, it needs to be enriched. So you focus on enrichment. With the Ukraine war, people are self-sanctioning away from Russia. There's a Russian ban in place in the U.S. So they got to scramble to go get enrichment capacity. And remember, just like there was a massive investment, which we could talk about in the underinvestment in capital expenditures in the miners for a decade post the 2011 event in Fukushima, same thing happened in enrichment and conversion. So scramble goes to get the enrichment services. It goes to get the conversion services. There's a few more uranium miners than there are enrichers or converters. So it's a pecking order. Where do they go? Where's the biggest pinch point first? Now, even with that, the price of uranium has gone from $16, $17 at the low to $80, right? So it's still had a big move. It's just that's the nature of the business. The fuel buyers control it, and I don't see that changing.
Okay, Mike, so you're saying that 85% of the trading is in the longer term contract market, only 15% is in the spot market. That immediately says to me that there's a vulnerability to manipulation in the spot market. And I know our mutual friend Justin Hune has talked quite a bit about somebody banging the month-end close. It seems like somebody consistently wants to get that month-end close down. Who's up to what? What's their agenda? What's going on behind the scenes?
So it's right. The spot market volumes could be 15% of overall, 20% of overall, sometimes a little bit more, depending. At post Fukushima, there's a little bit more, but in that ballpark. But what winds up happening is, it's like anything, Eric. What's the market structure? And it's really important to study the market structure here and know who the participants are. And in the world of physical trading, they're trading very, very near term. That's their time horizon. Their time horizon is in days and weeks and maybe months. It's not in years. And if you're an equity investor, you're looking at structural deficits, which means the amount of economic available capacity that a producer can produce. And that's where you see structural deficits over periods of time. And when utilities go to contract the same amount or more on an annualized basis than the available capacity, that's where you see it really start to take off. And we're entering that part of the contracting cycle. But in the spot market, now the long-term market, Eric, is only priced once per month. So at the end of each month, two price reporters will attach a long-term price to it. And that price is based on a base escalated price that is priced as though it's a fixed price that's going to escalate by X percent per year. That's how it is in a bear market priced, and that's how they price it in a bull market. It's not the way it should be priced in a bull market because very few base escalated prices are being signed in a bull market. The producers, they want exposure to a rising price. So they sign market related prices with floors and ceilings. And so it's very important to understand that distinction, but it's only priced once a month. So unless you're doing due diligence on a regular basis in the market, you're not going to really understand what's pricing and what the prices are. Not that it can't be understood. It's just that, if that's not your main focus, you're not going to be spending a lot of time there. So instead, what do people look at? They look at the daily price, which is a spot price that is reported. And again, the price is de minimis for this year. If you're looking at close to 200 million pounds of demand in the market, we're on pace to do this year, low $40 million worth of spot. So around, 20% or so of the market is spot. But the traders do not sell into long-term contracts. If you look at the data over the last 25 years or so, what you will see is they are almost non-existent in the long-term contract market because they can't guarantee pounds typically, right? They don't produce it. They don't have a mine that says we have a mine life of X. So they're very active. And what do? So what does the spot market look like? If I look at that 40 million pounds, like 45 million pounds, I'm looking in any given year, maybe 20% of the spot market is a utility just topping up. Another 20 to 25% of that is a producer that oversold their contract book, their capacity, and they go in and buy some pounds. And then the rest of those are traders. And so traders don't really have big balance sheets. What they do, they source their pounds from mines that provide offtake. They mines that don't have that produce, and they might sell into contracts, but they might have agreements with traders for a portion of their production. And so that could be in a given year. You can have 8 million pounds coming from Uzbekistan. You could have 5 million pounds coming from the French. You could have 4 or 5 million pounds coming down from Australia. There's one mine down there. But most of the producers sell into long-term contracts. So there's not a lot of pounds that are coming into the market. But what a trader's doing is they're taking those, and the way historically this and up to today this market gets priced is they say, okay, well, we're going to deliver into you every month, every 3 months, whatever the structure is of that contract. And we'll price it on, it could be the last Monday of the month at UXC, one of the price reporters. On their last Monday of the month at 4 p.m., we're going to price it there. And so what winds up happening? What you wind up seeing in the market, because there's not a lot of pounds trading, what you wind up seeing around the periods of month end or sometimes mid-month, but mostly month end, what you will see is you can see the cadence of selling coming from some of the traders will accelerate. And what they might be doing is they may be getting, and I'm using, I'm picking numbers. I'm not talking to anyone specific, but they may be getting 300,000 pounds coming in on an offtake, but they might want to sell 50 or 100,000 pounds. And there'll be aggressive sellers of those pounds, which they're entitled to do. And they might not otherwise have sold those pounds. So you will tend to see around offtake times, you tend to see pounds aggressively being offered in the market at lower prices. And sometimes it could move it down a couple of bucks, $3, $4, and then all of a sudden it gets priced. It's not a moving average of 5 days, volume weighted average price. It's date and time. And it's a silly way to set up the contracts, but that's the way they're structured. And so it just lends itself to people being motivated to get a lower price when they're going to price their contract. And that's what you see in the spot market. But, the spot market itself is that's not keeping the lights on at these reactors. It's just pounds moving back and forth. And a lot of these volumes, I mentioned 42, 44 million pounds, a lot of that is churned volume. It's trader to trader, trading it back to a trader and going back and forth. And that could be that easily can be 30% of those pounds. So of the 40 million, 44 million pounds could be 30, 40% of that. So your actual pounds that are swishing around the market are de minimis. But because it has a daily price attached to it, that's what people tend to focus on. They don't either have the patience or they don't want to just go spend the time to understand what's happening in the contract market. So it's often very, very misleading if one stares at the spot price to think that that's where the uranium market is. It's a big distinction in the market, but one that very few care to pay attention to.
Now, in any other commodity market, including several markets that are smaller in terms of dollar size than the uranium market, we have very efficient liquid futures contracts. What's going on? Why? And there is a uranium contract on COMEX, sort of. They use it as a benchmark, but it doesn't have any liquidity in it. What's going on?
There's no liquidity. So it's 250-pound contracts. If I'm buying, we buy physical uranium, I'm typically buying 100,000 pounds at a clip, not 250 pounds. And so it's never ever evolved into something that utilities or speculators was used as hedging. So there's no speculation really in the market. If you think about it, the traders are doing their thing. They're sloshing pounds around looking to make 25 or 50 cents a pound on a 100,000 pound transaction. But the utilities are not using the futures market. So globally, there's 60 nuclear power plants. There's 400 and something reactors, but 60 utilities that own these things. And, they're in the market when they're in the market. And there are cycles where they're contracting. But in the spot market, people say, oh, it went down $5. That could literally mean nothing. It's just like if it went up $5 could literally mean nothing. There was a couple 100,000 pounds sloshing around. Over time, it's an indicator, right? Is directionally it moving higher over a period of time? Okay, well, that's kind of telling you things are kind of tight in the spot market. But again, if the vast majority of pounds trade in the term market, that's kind of where you want to understand the supply-demand dynamics that are taking place. Like, for instance, this year, if I look at the beginning of the year on spot's probably down, I don't know, 10, 12%, maybe a little bit more, after having a massive run last year. But probably came in, maybe 15%, something like that. However, if I look at the term market, this year has been a light volume year in the term market, but prices are up in the low 20% range. So where the bulk of the pounds will trade over time, the term market, there has been a lighter volume year than the prior year, and there's reasons for that. There was a Russian uranium ban that was put into law in the United States, and they're still working through the guidelines and who's going to get waivers. So it makes sense for the utilities to kind of step back until they know what's happening, and that's starting to come around now. But yet the price is up 21%. Now, Eric, you understand commodities. You're a commodity guy. If volumes are light and demand, quote, demand isn't really strong for that, typically you're going to see prices go down. Here it's just the opposite. So the term market is showing you with very little term demand for reason I just mentioned, that it's a tight market. But yet people still stare at the spot market. And I think it's what they're used to. And again, most investors, there's not a lot of commodity investors in North America, or I should say in the US. Most hedge funds don't have a portion of their books dedicated to commodity type names. It's just not what they do. And so now you come into a market where you think, like you said, what's the futures doing? Oh, well, that doesn't even trade. Okay, well, what's spot price doing? That's got to be indicative of it. Yeah, well, not really. And so it takes a while for people to figure out the signals in the market.
Well, I know for a fact we have quite a few listeners who work for CME Group, so I think you guys are missing the boat here. I don't know. You got time to call me every time that you introduce some stupid new mini crude oil something or rather that nobody wants to trade anyway. You got time to call me outside of my time zone, but you don't have time to get this contract to be better recognized and used. Is there some reason, Mike, in the industry that people would not want to use a futures contract, or is COMEX just screwing up with the contract size?
No, I think it's a really good question. And I think it leads to market structure and complacency. I was just talking about the market structure for spot and how traders, what their incentives are is short term. If you look at the long-term nature and the market structure of a fuel buyer, right? And this is one of the hardest things that I've had to learn since, starting to really dive deep into the sector back in 2015 and 16 was I actually didn't believe it for a while. And I would have conversations and where you try as a commodity trader, you're trying to buy low and sell high, just like anyone is, right? And what really, really surprised me was, because there's such infrequent price discovery, because they're in the market so infrequently, a contract could be 7 years, 5 years, 10 years. And the fact of the matter is that actual uranium itself is mid-single digits to maybe 10%, pick a number depending on price of uranium, of the cost to operate one of these reactors. If you're running a natural gas or a coal-fired power plant, the feedstock is 80, 90%. And so what's wound up happening over the years is there's no financial incentive for a fuel buyer to call bottoms. Their only incentive is to make sure they don't run out of fuel. And because the cost of running it is, and I don't mean to minimalize the cost, it's still a real cost. And in some markets now in the US, they're all starting to get a lot of help from the government. But in periods where they weren't getting help, and in periods where it was a very competitive market competing against subsidized wind and solar, heavily subsidized wind and solar, it was challenging for them. But what wound up happening is mostly they paid what they paid when they had to pay it, as long as it guaranteed they got the source of fuel. And when I started looking at it and going around in 16 and 17, going and meeting fuel buyers at nuclear industry conferences away from Wall Street, and just trying to learn the business at a deeper level, it's one of the things that stood out to me was the complacency of a fuel buyer. Again, it's not It's not their intellect, right? I can't compete on IQ points against a nuclear engineer. And so they're very smart people. They just don't have the incentive. They don't get paid a portion of the savings that they make. The average fuel buyer, if he picks off a bottom and it moves materially, it doesn't matter. Conversely, if prices rip at it and they go higher like they have, they don't get fired. As long as they get the uranium, it is what it is. It's just where the market is. So that's led to this, what I would say, I've been investing 30 years in the hedge fund industry. I've never seen a cohort like this. Nothing's come close. I go back to in 2018, I went to the Nuclear Energy Institute, which is a large trade organization in the United States that pretty much represents the interests of nuclear power and in Congress. And they do a really fine job, and they're a huge organization, and they do lobbying. And I went to them and I said in 2018, guys, the forecast that everyone's using, and this is after having spent a couple of years doing a deep dive on supply and demand. I said, you don't know me. I haven't spent all my career in the nuclear industry. The supply demand that everyone's looking at is wrong. It's just not right. And the forecasters are looking in the rearview mirror. And they said, yeah, okay, get out of here. Who are you? And I kept knocking on the door, and I found a champion there that took the time to listen and laid out a presentation and said, look, these aren't my numbers. These aren't our numbers. We're not projecting. We're looking at the industry forecasts that are out there that form consensus, and here's why they can't be correct. We would like to share our view with people. Because I would be out at nuclear conferences talking to fuel buyers, and they're like, yeah, whatever. And I noticed that complacency. There's plenty of uranium. The recency biases were unbelievable. 2011 Fukushima melts down. Nuclear power basically. Nobody wanted it. It was left for dead. There was backed up. Uranium was floating around everywhere. And so for 2012, 13, 14, 15, 16, 17, recency bias crept in. There's always uranium. The price of uranium's in the high teens. It will stay there. Everyone told me, fuel buyer said it's going to 10. I'll bet you want a beer? I'll bet you a beer. It's going to 10. Okay. From 18, from 20. And so as you start understanding their incentives, I couldn't really wrap my head around it. Like, okay, so you're not, the structure is such that you just need to secure pounds. Anyway, the NEI was kind enough to invite me in 2018 to speak to their annual conference. I talked to enough people there where I showed them we kind of knew what we were talking about. And I went in Boston at an annual conference in October of 2018, and I stood up there and I said, you folks have done a fabulous job staying out of the contract market. When your contracts were expiring, the price of uranium was tumbling from as high as it was 137 in June of 2007. But after Fukushima, it was in the 60s then. And now it kept going to 50 and 40 and 30. And when their long-term contracts were expiring, the traders were doing near short-term carry trades with them. So they didn't recommit at high prices. So they did a great job. They stayed out of the market because there was excess supply post-Fukushima, and Japan was 13% of world demand. They shut down all 54 reactors. So it created a bottleneck and an excess supply at the time. But like everything, things change. And when you had years of inventory drawdowns, it was very clear that the forecast for the future was wrong. They were still taking into account excess drawdowns. I thought the demand numbers were too light. Supply wasn't being incentivized to come online. New supply was going to be needed, but you needed to bring it back online at a higher price because a lot of them had shut down. Anyway, I presented this case, told them what a wonderful job they did, and I got off the stage and I was literally verbally accosted by someone from the industry who told me I'm a terrible Wall Street person. I'm here preying on good, hardworking people, unlike me, because I'm a Wall Street person. I'm just a money-hungry, money-grubbing person. And I thought, wow. And she said, why would you want to scare these people? And I said, wow, I'm really not. I thought I'm trying to help them. And so I then asked this person who is an industry journalist, if you had a moment, I'd like to share with you our model. And we went over, one of the guys who works for me, Tim Chilleri, we went over to an enclave at the hotel and sat down and opened up our laptop and spent time and said, this is what this looks like. There's 100 tabs on here. And you don't get married to your model, but it's why I'm here. Like, this is it. This is original work. And after a while, that person said, oh my God, I'm sorry. I didn't realize the amount of work that goes into this. But sitting around the bar, talking to people, not a single fuel buyer cared. Now, I would speak to fuel buyers, but I had to go out of my way to get them to even say a word to me. No one followed up with me. No one cared. I'd see them at another conference. In 2019, the liaison at the NEI said, we need you to come back because I understand what you're saying is right. And we went back. And I gave this was in Nashville, Tennessee in October. And I gave an updated presentation and said, again, here's why consensus is wrong. And that was there that I was met with such disdain. Fuel buyers were telling me around the bar afterwards, I have no idea what I'm talking about. I should stay out of their business, that prices are going lower. Meanwhile, at this time, prices were already starting to move higher. And since then, by the way, prices are up 4.5x. But today, those same people who I still see will still tell me prices aren't going higher.
But hang on a second, Mike, because what I don't understand, if these guys were opposing you as traders, I would get it. I would say they were lousy traders, but I would get it. But these are people whose financial incentive is to make sure they don't get fired for running out of fuel. They can't get fired for anything else. So why wouldn't they just cite you as the guy who gave them, evidence? Well, because of what this guy said, that's my excuse for buying too much.
It's a great question, but in your question is the answer. It's the financial incentive that's lacking. They don't capture any upside if they don't get it right. Now, the very, very large ones, some of the very big utilities, they get it. They do the analysis and they cover themselves, but most of them don't. And because they don't have that financial incentive to get it right, because they'll just go pay what they need to pay. And it has by far been the hardest thing. And I give you an example. And it was 2017 and I was at a nuclear conference and we hadn't expressed the view yet through a vehicle. And I had just read an inventory report from one of the forecasters out there, and they referenced the amount of inventory out there. It was something like 1.4 or 1.7 billion pounds of inventory in the world. And at that time, if you looked at industry consensus, it was probably 170 million pounds a year, which would have indicated somewhere like 8 to 10 years of inventory, depending on the exact numbers. And typically utilities want to keep 1.5 to 2 years around. But I bought the report and I read through it. As I was reading through it, I'm like, oh gosh, this isn't like, most of this inventory is not relevant. It's not available. It's not economical. There's other purposes for it. That's not the real number. The real number might be, I don't know, 3.5 years worth of supply. If I'm really wrong, it's 4 years and they want 2, but it's not 8 or 10. And again, at that point in time, I'd been looking at it for a while, but not as ingrained as we are now. But all I had to do is take the time to read it. And I'm definitely not the sharpest tool in the shed, but I could read. And I'm like, yeah, this doesn't make sense. I had dinner with some of the biggest fuel buyers in the world at that conference. And I was talking to them and I said, can we talk about the inventory? And they said, what's to talk about? It's, I don't know if you saw I won't say the name, their inventory report. It's a decade worth of fuel out there. I said, oh yeah, but pardon me, forgive me. I really don't mean to pretend to know what you do or that you're certainly smarter than me, but no, there's not. There's maybe 3-4 years. No, there's not. They said there's 10 or whatever the number was in that ballpark based on the amount of pounds. I said, but there's not. Like, it's just, there is not. It's not economical. It's not accessible. If you got to the point where you were re-enriching it, it would be because prices are already gone nuts. But I'm telling you that that's not the amount of pounds out there. And again, I was met with, I have no idea what I'm talking about, like being patted on the head. And it was during those encounters where time and again, whether it was 17 or 18 presenting them, 19 presenting to them, one of the biggest obstacles, Eric, or one of the biggest things we have to be aware of as investors is our own biases, our own willingness to believe our own thesis and not look for why we're wrong, right? So I wake up every day assuming I'm wrong and try and figure out where I'm not. And so I always have come into it with that. But what I've learned to do, and you always want to hear opposing views, right? Because I don't have a monopoly on mostly on anything, certainly not good ideas, or I'm certainly not, don't assume I'm right. But that's this cohort, right? And I've not encountered that in a 30-year career, a cohort that does not want to hear a different view. Now, a few of that's not all. I'm not indicting all of them, but most of them, and to the point where now, and these same people each year at the conferences, I see them will tell me I'm wrong, and it's almost laughable. I've been right. It's been 4x at 4.5, whatever the price is, 4.5. I'm still wrong. What do you consider to be right?
Well, Mike, I'm going to interject a little bit of advice for any nuclear fuel buyers that might be listening to us. I came from the software industry, and I got to tell you, I also kind of had a reaction to the culture of Wall Street. Those money-grubbing son of a bitch stinking Wall Street guys. If that's what you think of Mike, fine, that's your prerogative, but here's a tip for you. When those guys, those stinking, slimy, sleazy, money-grubbing Wall Street guys are running a fund with a few $100 million levered up, betting against you, it's usually because they know something. Little tip. Anyway, let's move on. The big news, everybody thought that Kazatomprom, that's the big producer in Kazakhstan, where it's not the biggest resource in the world, but it's close to it. A lot of people thought, well, look, Kazatomprom could always scale up their production anytime they wanted to, and that was one of the reasons the buyers would say, or that seemed to be making them so complacent. Kazatomprom can always scale up production. There's nothing to worry about. Then August 23rd, which by the time our listeners hear this interview will be a couple of weeks ago, they guided down 5,250 metric tons. That's 7.5% of global supply that just came out of the market, at least in terms of that guidance. Now, that's not news, frankly, because you and our friend Justin Hune over at uraniuminsider.com have been predicting this for years, that Kazatomprom didn't really have the spare capacity everybody thought. Now that the news is out, it seems like they're still not taking it seriously, at least not as of while we're recording this on the 28th of August. What's going on here?
It's a great question. I'll just refer you to the slide deck. On the slide, realized production and all-in sustaining costs. Again, if you came into this industry from and you applied a playbook, right? 40% producer, a state-owned entity, right? You would think they could sell it whatever they want to sell at. It's not a big deal. Having studied this company very closely for many years now, even before it was public, one of the things that stood out to us was this was to some extent a foreign currency play. And what I mean by that is it's a company that is in Kazakhstan. They cost in tenge and they sell in dollars. So when the tenge is weak against the dollar, they get a margin boost. And because they're selling in dollars against a weak home currency. And, if you go back and look, they're the world's lowest cost producer, right? So they were coming public in 2018, 2019, and they put out a big prospectus. And at the time, the all-in sustaining cost was to produce a pound of uranium in a, $13, $14, $15 range. Versus if you're looking around at some of the top tier in the West, you're looking in the high 20s, low 30s, and even a little bit more. And so it was thought that's this great advantage. But if you went back and did the analysis before they put out the big prospectus, they were a private company, but they had public debt. So they did have an annual report. And if you went through that back in 2012, 13, 14, that's around 13, 14 when they devalued the currency. And it went from 70 tenge to where it sits today at 480 tenge to the dollar. But if you look, you realize, wow, those guys produce uranium in the mid-30s. They're not really a great low-cost producer. They've been a great beneficiary of a devalued currency. And so in 2017, the world's largest producer came out before they were public, and they cut supply. And the way it works over there is the state-owned entity, Kazatomprom, has an agreement with the state, with the government, that they will produce X number of pounds per year, and they can go plus or minus 20%. Those are called subsoil use agreements. And they're codified through a competent person report. How big is the resource? How many mines do they have? How much will they produce? And what they came out in 2017 and they said, we're going to cut 20% below our subsoil use agreement because the market is out of balance and we don't like the low uranium prices. So that was 2017. So here you had the state-owned producer, lowest cost, and they said, we're going to focus on a value over volume strategy. And the way everyone applauded it, say, well, that's great. And 2017 came in, and then they came public 2018, 19, and their costs were $12 a pound, all in sustaining costs. And then 2019, they produced about 59 million pounds of uranium. And then 2020 came along and COVID came, and they kept minus 20% below subsoil use. And then 21, minus 20% of subsoil use, value over volume. They couldn't produce. COVID, of course, was a challenge. And then 22 came along, and then they kept it. But in 22, in September of 22, they guided for the 2024 production was going to be minus 10% versus subsoil. So they were going to increase production. But by the time 23 came along, during 2023, they took that minus 10 for 2024 production guidance, and they took it to minus 23 to minus 27. Now, if you were familiar with subsoil use, you would know that if you go below minus 20, you need to go back to the government and rework them. And that's a pain in the neck. You don't want to be that person. You don't want to be that management team. And by the way, this is the fourth management team, CEO, CFO in the last 5 years. But what happened during that time period is this world's low-cost producer, which was producing uranium by 2019 at $11.94 a pound, all in sustaining cost. If we fast forward to today, for 2024, their guidance is 59.8-ish, 60 million pounds. So the same as it was in 2019, 59 million pounds from a scale standpoint. The difference is it's going to cost them $28 a pound, not $12 that it did then. And if you looked at their prospectus when it came out back then, it's 700 and some odd page prospectus, they had forecasted a all-in sustaining cost of around $12 by 2024. Instead, it's going to be $28. If I could point you to the CapEx per pound slide, you'll see that CapEx per pound has gone from $3 in 2019 to almost $10 in the first half of 2024. It's costing a fortune. And if I took the currency, the 340 tenge to the dollar that was being used for the forecasted years forward, not the 480 today, so the currency's devalued another 40%, the constant currency cost is $37.96 or $38 a pound. So what's happened? Well, they've not, and for by the way, for 2025, they just gave guidance of a reduction of 17% versus the subsoil use agreements. So basically, you have the world's largest uranium producer that is producing the same amount of uranium, a little bit more, same amount of uranium in 2024 as they did in 2019. Their costs have gone from $12 a pound to $28 a pound. If we use the same constant currency they guided to back in 2018, it's really $38 a pound. And then they're looking to next year, you'll have a little bit higher guidance, but which is down 17% versus what their subsoil use agreement is. So you asked what happened. On August 1st, Kazatomprom came out and they said, we are not going to be down 23 to 27. We're going to be down 20%, which is in line with their legal limits that they're allowed to be, which was an increase of 6% in guidance, but still 20% below where they should have been. And the headlines in the newspaper was the world's largest uranium producer ramps production 6%. And I have never seen a bigger ready, fire, aim reaction to a market. They took the equities down 7-8% that day because big bad Kazatomprom, whose costs have gone up 2.5x, who is struggling to produce uranium at the clip anywhere near the clip they want and use the value over volume, which we'll take. But if you go back, Eric, and I'll wrap it up on this, in 2005, they were producing 9 million pounds of uranium. They were forecasted to produce 22 million by 2015. Well, by the time it got to 2015, they were producing 56 million pounds. And so they came on like gangbusters and they flooded the market with uranium, but they that was their best shot. And since then, it's been a series of underproducing and costs spiraling out of control. So fast forward to August 1st, 2001, and you get a period of August 1st, 2024. They produced that, the stock sell off. Well, here just on August 23rd, they came out and said for 2025, we're going to be 17% lower than our subsoil use agreements. That's significant. You're talking close to double digit of world supply than what they were forecasting. And so Kazatomprom is obviously they're a large producer, but it's a state-owned entity in Kazakhstan they produce on their own, and they also have joint ventures with Western producers, with Cameco, with Orano, the state French-owned utility, with some of the Chinese, with some of the Japanese. But if you were Cameco, what was really appealing to you was to be a participant in Kazatomprom in Kazakhstan, in the mid-teens, and because you could produce pounds at a low cost and much lower than you can produce in northern Saskatchewan, which is the highest grade reserves in the world. But you had lower costs in Kazakhstan. Now, if you're Cameco today, you've got the same costs as you do in northern Saskatchewan. So, for them, Cameco, I think, they're incredibly well positioned, but Kazatomprom is not the field of dreams that people think it is. And so when new people come into this trade, what I have seen, my phone now, because of the data center play and because a number of the investment banks have picked up coverage, it's not uncommon for me to get calls from multi-billion-dollar hedge funds who want to come into the trade, who have been looking at it for 2 weeks and tell me how it's going to work. And I'm like, okay, let me hear your view of the world. And they just assume that 800-pound gorilla Kazatomprom is going to control the market. Kazatomprom, are the wheels falling off the bus? I don't know, but the bus is in trouble. So that's our view. As to your question, why doesn't it move? Again, the stocks went on the 23rd because the stocks moved up 7, 8, 9%, but the spot price didn't move. And it's similar to what I've been telling some of these big funds. I get phone calls, hey, AI and data center, nuclear is a beneficiary of that. I really like the trade for uranium. Okay, great. I could see that in the future, but a fuel buyer could not care less about buying uranium today because you think that data centers are going to be used. They will. Ultimately, it all accrues to the uranium producer, but not in the spot market on a given day. So, for instance, the equities responded as they should have because it just creates more of a deficit. There are huge structural deficits in this market, in the contract market, where annual consumption is greater than annual economic supply, significantly more so. By the way, 2030, 25% of the supply that is needed to meet the demand in 2030 is not a mine. It's not permitted. They're not built. They're not financed. Nothing. So it's an enormous structural deficits. But on a day-to-day basis, the spot market will not react to it. And that's what you just need to figure out, how you can recognize and rationalize that the spot market isn't the market that needs to be focused on. So long-winded way of saying, the Kazakhs, yes, they're a big producer, but they've got significant challenges. And by the way, it's a bifurcating market. More and more and more are those pounds headed east to Russia and China. So 65%, 70%, I should say, of uranium is produced in the East. 70% is consumed in the West. There is so much geopolitical risk in this trade. It is unbelievable, and it gets ignored mostly by fuel buyers.
Mike, I want to focus on what you just said about East and West, because I think it's really important. We've already got U.S. foreign policy, we've had this Russian import ban without a lot of thought, frankly, as far as I'm concerned, on U.S. lawmakers' part about whether that jeopardizes supply that we really need access to. You just said Kazatomprom is basically providing mostly exported supply to the West. What would happen if a further escalation in this Russia-Ukraine conflict cut that supply off so that the West no longer had access to any supply from Kazatomprom at any price because it's sanctioned either by the United States or by Russia? They won't let it be exported. What would that do to the market?
Great question. And, the influence of Russia is more and more apparent in Kazakhstan, in Kazatomprom. They are a force to be reckoned with within Kazatomprom. And the Chinese are there too. But it's a great question. And it's one that I think the fuel buyers have been unbelievably complacent on. And if something were to happen, if, the U.S. banned Russian uranium, but should the Kremlin decide not to send fuel in, you don't forget at any point in time between Kazakhstan, Uzbekistan, and Russia could add up to as much as 50% of the imports to run the nuclear power plants in the United States, which is 20% of the electricity. But to think about in conversations with fuel buyers and understanding how they think, the complacency is staggering to me. It's unbelievable how they, whether for the reasons you mentioned or for whatever else, they just are somewhat complacent, more than somewhat complacent about it. I personally think it's crazy.
Well, let's focus on that then, because unlike most trades, it sounds to me like this is not really about supply and demand. This is about buyer complacency. And at some point, there must be some forcing function, some event that wakes them up. What is that event, and what happens when they wake up and recognize, oh, wow, there really is a risk that we might not be able to buy the fuel we need at any price if the West cut itself off from Russian and Kazakh supply?
From a supply-demand standpoint, that horse left the barn. They just haven't been smacked upside the head yet by it. They will. They absolutely, in our view, will, because it comes down to this. I mentioned earlier, it's a contracting market, the vast majority of pounds. During lean years, when there's excess supply in the market, the utilities contracted about 35% of their annual demand. They did that from 92 to 04. They drew down inventories. And then they contracted from 05 to 2012 at almost 115% of annual demand. And they paid through the roof. Prices went from $7 in 00, and then they went to as high as $137 per pound in 07. And then when Fukushima came around, the prices were in the 60s. But since Fukushima melted down and you had excess supply, lo and behold, they recontracted about 37% annual clip. And what's happened? Inventories have been sucked down. How do we know? Because prices of term pricing has gone, and spot is, they're both up 4.5x. And so you're starting to see contracting occur again. And so when economic demand, when they start to contract to their annual consumption, and last year you were close, this year, for the reasons I mentioned before, it's pulled back a little bit. But that's where the rubber meets the road. That's where the economic capacity, that's why pricing is up 21% this year. That's normal supply and demand. They're hosed on that scenario, right? You can hold it off a little bit. You can borrow some pounds here. You can do what you need for the next couple of years. But we're not talking in mining the next couple of years. There has been a massive underinvestment for a decade. And so now, like I said, one of the biggest numbers that jumps off the page is 25%, as much as almost 25% of the pounds needed in 6 years from now, which is tomorrow. It's dog years in mining. It's not even permitted yet. It doesn't exist. It's not a mine. Now, layer on to that other risk, the geopolitical risk, Eric, and that's where, if things get a little out of hand, they get out of hand. And you know what? So be it. They were warned. They had every opportunity to cover themselves. And, that's, hey, welcome to capital. Welcome to the capital markets. They'll figure it out.
Now, you said that the market generally is 85% long-term contracting. And what that says to me is, unlike something like crude oil, where you've got to balance supply and demand right here, right now, because there's a physical problem with not having enough tanks to store it in. We don't have that problem with uranium. So I would think, given that this is a long-term contracting market, it should be forward-looking. So therefore, when you get something like, China doesn't even announce new reactors individually anymore. They seem to be bulk announcing a dozen at a time, okay? You've got the Triple Nuclear Initiative where, 25 nations have signed on to building 746 gigawatts of additional capacity over the next, 25 years. These are things that you would expect. Each one of these announcements would be a shock that sends, just tremors through the contracting market. There's zero. How can that be?
again, it's in the contracting market, though, it's up 21% this year pricing. So they're starting to recognize it on very low volumes, right? But again,
but these news events, the news event of the triple nuclear, nothing, zero.
They don't react to news events because it's long lived. And so what they will do is they will go out and it's another bizarre function of this market is they get together at annual conferences. You'll be there. I'll be there in London next week. And they get together, the producers and the fuel buyers, and the fuel buyers will say, well, yeah, we're okay. But then they'll start these contracts are mostly bilaterally negotiated. They're not RFPs, requests for proposals, go into the market. That's just for the fuel buyers to kind of sniff out where the pricing is. But then when they really want to get down to brass tacks, most contracts are signed under, hey, let's sit down and hash out what we really need. I feel pretty good from our due diligence that you're going to start to see that accelerate more, which we think ultimately will lead to higher pricing. Where prices go bananas quickly it's shocks to the system, and it's very perilous. I mean, their supply is, it's on a razor's edge, and whether that's a news event, if a mine has a fire or a flood or something, that tends to jolt it right away. But now it's just been a steady progression of rising term contract prices. Like I said, now to remember too, this is really important to somebody learning the market. They'll look at the long-term contract and say $80, up 21% that year. That's great. It was down as low as, in the 20s, not, a handful of years ago. But that's not the price. And this is another bizarre characteristic of this market. The price is quoted as a base escalated price. So it's quoted as though in a bear market, when the buyers are in control, they tell a producer, we will pay X dollars plus we'll escalate it 3% a year, taking delivery 3 years from now. And you can escalate it in the next 3 years, but that's the price. In a bull market where the suppliers are in control, and what's happening now is the utilities or the producers are telling the utilities, listen, we're not going to give you a fixed price. We want market exposure. We want market-related pricing. And so what they'll do is they will say, and the utility will say, okay, and this is how they have a problem, because they're doing market-related contracts. That's most of the contracting. So right now, the ceilings are in the $120 range. Again, the price is being quoted at $80. And the floors, $75. So if I'm a producer, I can sell a market-related contract, and I got $5 downside and $40 upside. That's really asymmetrical, right? So the fact that those are the parameters that are being seen and contracted for in the market, yet the price reporters still report yesterday's news, just like they forecast yesterday's news. They're pricing a contract that is by far the one less being conducted in the marketplace. So it's really important to understand those nuances and those distinctions that are taking place right now.
Okay, so it sounds like you and I are in strong agreement that this is an incredibly bullish setup, that what's going on here is there's going to be a massive deficit of supply relative to the expected demand, which we know is going to increase tremendously with all of these new Chinese reactors, with the triple nuclear initiative, and frankly, just to meet existing demand. We would still be remiss not to talk about what the potential bearish factors could be. So it seems to me, I mean, obviously the Fukushima disaster really did a number on this market for a number of years. What if somebody were to take out either the Kursk or the Zaporozhye nuclear plant? Somebody bombs it and it results in a great big, environmental disaster with a lot of radioactive contamination. Now, that's not a failure of nuclear energy, but I guess it does expose a vulnerability that these plants could be targets in a war action. Do you think that has a Fukushima-sized effect on the market? I mean, what would it do?
I do think, and that's one of the risks when people ask me, like, what are the key risks, like you're asking? That's one that you just hope cooler heads prevail, because I do think if there was a major event, I think that people would get scared. I think they would say, I get it. It's really clean. It's all that. But geez. Now, I would also point out to, these things are designed, the updated ones with the containment domes, to handle a 747 hitting them. But some of the older ones, like you're in that region where you are right now, not so much. So, yeah, I do think it would certainly have an impact on sentiment, without a doubt. I think you asked what are other risks. I think the Kazakhs have had this value over volume strategy, as I talked about, where they're producing less and making more. I think a lot of that's forced upon them because I think they have production problems. When CapEx per pound goes from $3 to $10, you have problems. When your all-in sustaining costs go from $12 to $28, you have problems. So I don't believe that it's this altruistic, we're just really wanting to be, really value over volume folks. I think a lot of it's forced on them. But down the road, should they be able to get their spiraling out of control costs under control? Should the Russians have more of an impact over there and with a heavy hand, which I think is not is something you always have to think of. Whatever might have, can they lose their value over volume? Sure, it's always something that you have to be aware of from a risk standpoint. One of the things we're always looking for is the Chinese have a significant amount of inventory. Now, they're a big driver of the nuclear cycle, and they've built up inventories that are significantly greater than you have in the West. But that makes sense with how they think about things. They think about things from a 50 to 100-year standpoint, whereas the U.S. and Western European fuel buyers are looking to have 2 to 3 years of inventory, right? So it's a different mindset. China is not blessed with copious amounts of indigenous uranium, so they've got to go to tough places of the world to try and get it. In parts of Africa, that's really challenging for them. And they keep building their war chest of uranium inventories. But it's certainly something that we're always looking for. Is there some sort of, could there be a change to that attitude? Can they decide that, one of the things the Chinese do sometimes in other commodities is before they want to go into a major contracting cycle, it's not uncommon for them to dump some pounds into a market so that they could drive pricing down a little bit. So that's something we're always on the lookout for, right? Because we can't be complacent and say, oh, that can't happen. You just have to be aware of things like that. On the policy front, that's been something that has surprised us to the upside. There's been far more support than I ever thought we would see. Just 5 years ago, I never thought we'd see the policy support we're getting now. But I do think, there are things that you have to be aware of. One of the things I disagree with, and I think people who point to that, I don't think there are excess inventories floating around. I think in a thin spot market, you can drive the price down a little bit by dumping a few pounds in the market. But I've seen people say, oh, there's 1 billion pounds. No, there's not. In number, there may be in total, but that's not in the commercial fuel cycle. That's not out there. It's just not the case. But yeah, look, to Zaporizhzhia, Kursk go down. I think I think you have people get scared by that. And you see it day to day in the market. It's reflected in the equity prices.
Well, Mike, I could keep asking you questions for 2 more hours, and I look forward to doing that when I see you in London the same day that our listeners will be listening to this interview. But before I let you go, please tell our listeners how they can contact you at Sachem Cove Capital.
Thanks, Eric. They can always just go to our website. I think it's sachemcove.com. I think Sachem Cove Partners, sachemcove.com. My business partner, Tim Rotolo, handles all the inbound inquiries. So, that's how they could find us.
Fantastic. And from a compliance standpoint, Mike cannot tell you to contact Tim Rotolo if you are an institutional or accredited investor looking for a tear sheet on the fund. But since I'm retired from the hedge fund business, I'm allowed to say that. Patrick Ceresna and Nick Galarnik will be back as MacroVoices continues right here at macrovoices.com. I'll be sitting out today's postgame because I'm in London having a beer with Mike.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Great interview with Mike. Now joining me in the post-game segment is Nick Galarnik. Nick and I are recording the post-game this week Eric will be back with us next week as usual. Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Mike's picture saying looking for the downloads. Now, Nick, I want to start off here by just having a quick look at the crude oil chart. And we once again had a negative spill on the downside. It rejected the 50-day moving average and just broke to a fresh new low, not holding the $72 level. And we find ourselves here in quite a short-term oversold state, trading right into the 2023 lows. Now, that doesn't mean that it can't break to a lower low or even go to like $65 or $60. But usually, technically, when you approach a major support line, it offers a reaction along there. And so one of the things that I'm looking for here in the $68, $69 level is whether a very typical reactionary bounce happens, sending us back towards $72 to $74. That wouldn't necessarily be bullish beyond just a bounce. There's going to be a lot of work for the oil bulls to turn this around. It could be a prolonged basing formation that could go deep towards the elections before the bulls have the technical structure to put together something bullish on the upside. So moving on to page 3, we have that S&P 500. Nick, let's just start off with your levels.
Yeah, Patrick. So right now on SPX, we have a spot price of approximately 55.20. And we have an implied move that actually increased from last week from 140 points to 160 points for the September 20th monthly OPEX. So we have an upper implied move, therefore, of 56.80 and a lower implied move of 53.60. Right now, we have key resistance at all-time highs at 56.70 and key support at 5,500. Right now, I'm inclined to think we see some more up and down action, kind of like a kangaroo market overall for the next few weeks. And one thing to keep in mind, too, is that we've already declined by about 2% for September so far. The average decline over the last 10 years in September is 2.3%. So I'm not so sure we get that much more downside in the short term, though a lot of people expect that. I'm more inclined to think we see a bounce between the 5,400 area and the 5,600 area for the next few weeks.
Well, it's interesting because we're trading right at the 50-day moving average. Now, the reaction down was on the ISM manufacturing numbers that came out on Thursday. And we continued to see things like the JOLTS and ADP jobs numbers coming in weak. And that certainly has contributed to this coming off. I think really this is going to be all decided on Friday when we get that jobs numbers. Because if it comes out negative because bad news is bad news, we could spill down to 54 400 on the S&P futures on a quick move. I'm not so sure that the market is going to have the floodgate open before the FOMC meeting. And so even if we did have a spill down there, the 5,400 area is very close to the 50% retracement of the prior rise. So it would be a very logical place for any short-term weakness to find that short-term support. There is lots of opportunity during technical topping formations for the market to have numerous fakeouts. To your point of there being numerous false starts and like a ping pong match between support resistance, it's entirely possible that we even pop up towards the 5,700 highs after a negative reaction, creating maximum confusion for many traders. And it'll certainly be possible for things to play out that way. The interesting part going into the second half of September is that many of the share buybacks get frozen going into the earnings season of October. And so that certainly will influence some of the flows, and the particularly weakest parts of September are the last 2 weeks of September. And it's interesting that that falls right after the FOMC meeting. Now, usually when something is so well advertised, like an event that the market is weak in those 2 weeks, rarely does the market deliver on expectation. So there's certainly lots of confusion going to be going in here. The bigger question is, does the market start some sort of big trend move prior to the elections? Or just like you were suggesting, are we going to have far more fake out moves and grind out towards the U.S. elections? Right now, anyway, 5,400 is my lower support line, and I don't necessarily think any sustained rally above up to 5,700 will hold either. So that's my tight range. Now, moving on to the Nasdaq on page 4. Nick, what are your levels here?
So right now, spot price on Qs is approximately 458, and we have an implied move of plus minus 18 points for the September monthly OPEX. Therefore, the upper implied move is 476, and the lower implied move is 440. Right now, we have key resistance at 485 and key support at 450. Now, post NVIDIA's earnings last week, we saw them decline over the last few sessions, and that's brought down the entire tech sector overall. However, there are some deals to be had, in my opinion, namely Google's one I'm looking at with a forward price earnings ratio of about 18 or so. And overall, I'm inclined to think that we see the market kind of chop over the next few weeks. So I'm going to be waiting this out and watching from the sidelines with more long-term view on names that I want to buy on dips.
Yeah, it's interesting. The Nasdaq continues to underperform and continue to do worse than the other indices. So, example, this morning we are down 0.5 point on the Nasdaq while the Russell's flat. This we continue to see this trend where the selling is targeted toward that tech sector. When you look at those Mag 7s, whether or not you want to look at the valuations, bottom line is beyond Apple's bounce higher, most of the Mag 7 stocks actually have very weak charts that are trading below their 50-day moving averages and have been on balance distributed. It's certainly been the trend for the last few weeks, and it'll be interesting to see whether or not that trend continues as we move forward. So, Nick, I wanted to move on to page 5 here, where we have the volatility index, the VIX trading up in the 20 handle. What are the implied ranges for you here?
So right now with the VIX at a 20 handle, we can expect to see intraday top to bottom ranges on SPX of approximately 1.25%. And important to note that with the election coming up soon, it's probable we see elevated volatility into that time period. So insurance is more expensive now than it was last week, for example, by a factor of about 25% or so. However, if your portfolio does correlate heavily to S&P, it makes sense to perhaps take some hedges in the form of perhaps callers into the election event, as that may be a volatile time period overall. And moving on to that page 6 dollar index, we have the chart here, which is showing us trading near the 2023 lows. What are you thinking here?
So when we're taking a look at that US dollar index, it has been actively distributed. Lower highs, lower lows, persistently below all of its key moving averages. But it's at that major support line you highlighted. But the question is that a support line that can hold? We have to dissect this by looking at some of the individual currency crosses. Particularly the one currency that's been driving this has been the yen. That US dollar yen collapsed from the 162 level, hitting 142 back in August. And we're finding ourselves trading right back toward that low. The December 2023 low was near 140. And so we're a stone throw away from some key support lines being tested that could offer a short-term reaction in the dollar in that very important currency cross. When we look at that euro, it traded right to major overhead resistance from 2023, trading in that kind of 111 to 112.5 area where all those highs came in. And so there's a lot of, even though the trend has been very pronounced to the downside, we have some key technical resistance and supports that are coming in that could offer a reaction. With a lot of major economic catalysts and FOMC rate cuts scheduled for September, it'll be interesting to see whether or not the dollar establishes a short-term low and a potential trend shift.
Patrick, moving on to page 7, we have that gold futures chart, which is making new all-time highs. I think we're going to see it perhaps pushed near 3,000 in the near term. What are your thoughts here?
Well, it has been behaving very well. Like you look at even just something like silver, which is the cousin of gold, the pullbacks have been deeper and more pronounced. Gold, even during these pullbacks, seems to be bought on dip almost instantaneously and trades right back to the highs. It exhibits all the characteristics of healthy accumulation. The trend has been primarily up, even a pullback towards 2450, which would be a very typical technical event, didn't yet yet develop. And so if this manages to break to a higher high, there's a technical measure moves that are measuring up to the 2700 area, which would be a very logical short to intermediate target on the upside and would be a real clear indication of a continuation of this bull trend that has been quite intact in spite of a lot of carnage in the entire commodity complex. Now, Nick, on page 8, I have that copper chart. The downtrend and the sell-off has been relentless over the last 3-4 months. And now we had a bounce over the last few weeks that saw us test the 50-day moving average and approach a 50% retracement of its prior decline. And yet we roll over here. At this juncture, the primary downtrend is still intact. Now, while I think that we're much closer to the bottom of copper and don't think that there's a huge downside, there's also no technical evidence that the bulls have come back in play here and that a new bull trend is imminently about to resume. I think there's lots of vulnerability in this challenging few months for, let's say, copper to take a couple of stabs below $4, retest those 2023 levels where it spent a lot of time in that $3.75 to $4 range. And that's where a lot of the bottoms come in for what will inevitably be a very bullish setup, probably sometime in October or November. Right now, in the short term, I think that this consolidation is still the path of least resistance, and we're going to have to see where the bottoming formations develop.
Now on page 9, we have that uranium chart, which has been hovering between that 23 and 25 area for the past month or so. What are you thinking here?
So far, uranium has rejected its moving averages and has failed to break the downtrend. But we are seeing finally the price action behave in a divergent manner. And if we see that uranium stops making lower lows here and establishes a base, this could be the price levels from which a potential technical bull breakout could happen. What I'd be looking for on the Sprott Physical Uranium Trust chart would be a decisive breakout above the $25 level, breaking that descending channel and potentially demonstrating that some sort of new accumulation cycle may have begun. It is a little early to be making that kind of a call, but it's certainly now a level where it could happen. And so it's high on my watch list to see whether or not it develops a breakout. Finally, on page 10, I wanted to look at the 10-year yield, and we find ourselves after the weak ISM numbers and the weak jobs numbers that have been rolling in, that the yield is now down below some of the August levels and actually very close to its one-year low. The big question, of course, is this a level that will be broken on the downside in the post-jobs numbers on Friday? And this is a line in the sand. If there was going to be a catalyst for yields to rise on some sort of a strong jobs numbers, it certainly would happen tomorrow. And so I think this is a very key technical level. If we see the jobs numbers come in weak and this remains below 380, the downside window's open to 350 basis points very easily. For those of you that enjoy these chart decks and the conversations, you get them every single day at Big Picture Trading.
Now, Patrick, tell our audience what they can find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, as well as the slides that Mike provided in the chart book we just discussed here in the postgame, and including a number of links to articles that we found interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend. That is Eric spelled with a K. And follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.